The dollar has lost about 5% this year, so how are ETFs trying to de-dollarize? This is Inside ETFs, and we're talking the so-called debasement trade. That's the idea that the falling value of the dollar creates a challenge for fund managers to move money into assets that aren't measured in US currency, whether that's digital assets like Bitcoin or hard ones like precious metal and critical minerals. Cinthia Murphy is an investment strategist at VetaFi. Firstly, Cinthia, why would you want to get away from the US dollar?
Hi, Elena. It's been kind of a big story this year. It's the debasement trade, as you called it, is actually a term Morgan Stanley coined earlier this year. And it's really started because if you remember when we kicked off the year in the first half of 2025, the dollar dropped over 10%. It was the weakest start since the early 70s. It was a wake-up call. And, if you think about the state of the global, central banks and fiscal policy, trade policy, there's a lot of stormy skies ahead for the dollar. And so folks started looking for ways to kind of minimize a little bit of the dollar risk in portfolios, which is so prevalent everywhere you see. So it's a theme that has been growing this year. The dollar recovered a little bit, but Morgan Stanley itself says we should expect another 10% decline next year. So I think it'll be a persistent theme going forward.
So there are a few ways to do this, of course. One is hard assets, most famously gold. It's had a huge run up this year. But ETFs are spreading exposure beyond gold, aren't they?
Yeah, it's really a search for things that do okay, whether it's in the face of inflation or that are not so dependent on the dollar. So really you're in search of assets that have finite supply or that inelastic supply. So things like precious metal. Gold is up more than 50% this year. Silver is up almost 70. Copper is up almost 40. So it's really been these minerals, the metals where you don't have infinite supply. That has been a great spot for folks to go and minimize a little bit of that dollar risk. And then your traditional kind of inflation fighters, things like hard assets, commodities, real estate. Even in the equity space, we see that demand materialize in things like infrastructure stocks, industrials, utilities, these parts of the economy that don't depend so much on inflation. They can do whatever they want because there's no competition. You need water, you need utilities. So those are safer parts of the equity market in this kind of environment, and we've seen folks flock to these parts of the market.
Another way is to move into crypto, but why would you buy a crypto ETF rather than just buying the cryptocurrency?
Yeah, the crypto ETFs have been a phenomenal space. They just came to market, as you know, last year, so kind of still a new area. But it allowed folks to put crypto exposure within their ETF portfolios because they're all the same investment vehicle. So it kind of opened the floodgates to exposure. Bitcoin, Ethereum, crypto this year actually has had a tough year. They're all in the red, as you know. But we are seeing that instead of bailing on that exposure, folks are buying that dip. Flows keep growing on all these products. We're now seeing in the United States institutions really doubling down on it and buying the dip, as you say. Some like endowments have tripled their exposure to crypto this year through the ETFs. So it's a space that even in a year of performing weakness, we're still seeing demand materialize. And a lot of it has been this push to de-dollarize. It continues to push demand even when prices are struggling.
Isn't this potentially risky, though, as you said, as investors run for cover, as we're seeing this week in the markets? Gold, Bitcoin and other hard assets are falling along with equities. So doesn't that undermine the argument?
In a way, you're diversifying your equity risk anyway. So I think overall, it's a good practice to have your not all your eggs in the same basket. So you have a little bit of your commodities, your alternatives, your currencies. So I think it's a smart move, actually. And we shouldn't expect all parts of your portfolio to be going up if you're properly diversified. Some things are doing as well as others. So I think it's been an interesting year for that kind of broader diversification away from your typical winners we've seen in the last year, like your Mag 7s, and a little bit away from that dollar exposure.
You mentioned, of course, the collapse in the dollar earlier this year, driven by geopolitics, worries about tariffs. That has eased considerably. The dollar's at a 9.5-month high now as the market gets used to a new level of tariffs. Is this strategy already looking a bit out of date?
So the dollar has rebounded, which we all feel relieved about. A lot of experts are still expecting that pressure to remain. this concern that, maybe this move away from fiat currency a little bit, thanks to crypto, central banks around the world trying to cut a little bit their exposure to US treasuries. There's a general movement to trim a little bit that exposure to the dollar globally. And so firms like Morgan Stanley, for example, expect that right now is a calming of the seas, but there could be more storms ahead. Their projection is another 10% decline in 2026. So I guess we'll have to see. It could be that things improve, but there's still expectations of some pressure on the dollar.
That was Cinthia Murphy of VetaFeed. Don't forget, you can watch more videos on Reuters.com.